Okay, we'll get started. So good afternoon, everybody. My name's Amy. I'm the Employee Relations Manager here at West Yorkshire Pension Fund. I'm joined today by my colleague Ahmed, who will take you through the presentation this afternoon. So as you can see on the slide there, it's Pensions Awareness Week, and we've run a different presentation every day this week to try and raise awareness and educate our members about the LGPS and all the different benefits that it has. You may have joined us on one of the earlier days throughout the week, so hopefully today we're going to give you a bit more information around increasing your benefits. So today we are going to be talking about topping up or increasing your benefits. So we're going to look at the AVC option and the APC option, which you may have heard about if you have joined us earlier in the week. Presentation is going to last around 40-45 minutes. If you do have any questions, we will pick those up for you at the end. So if you want to just pop them in the chat box, chances are your question will hopefully be answered within the slides. But if it's not, we'll pick that up for you at the end. We are unable to answer any questions that relate to your specific circumstances or discuss any figures with you. But what we do have in the presentation this afternoon is, of course, some contact details for our help desk. You can give them a call and they can access your pension record and go into things in a bit more detail for you. The slides are available on the website, as will a recording of today's session. That will also be available early next week. And that's it from me for now, but I'll pick back up at the end to address any questions that you've got. So over to Ahmed. Thank you very much.
Brilliant. Thank you, Amy. And hello, everybody. So as Amy mentioned, my name's Ahmed Surti. I'm part of the Employee Relations team here at West Yorkshire Pension Fund. So in today's webinar, we'll be covering the following topics in regards to increasing your benefits. I'll be giving you an introduction to topping up your pension and introducing the two methods available to you for increasing your benefits, which is obviously APCs and AVCs, as Amy mentioned. I'll demonstrate how the two options work and what this means for your main scheme benefits and your income at retirement. Firstly, I'll delve into APCs, which stands for Additional Pension Contributions, explaining how they work, where to access the information, and how to start an APC contract. And finally, touching upon the main points you need to consider if this is an option that's for you. Secondly, I'll delve into AVCs, Additional Voluntary Contributions, again explain how they work, where to access the information, and how to set up an AVC. And I'll again cover the key points to consider in your decision making. I will briefly touch upon shared cost AVCs, which may be an option if this is something that your employer offers. And finally, I'll make you aware of the additional resources available to support you in regards to these products, should you wish to proceed with any of these options. So following on from yesterday's session on understanding your annual pension statement, you'll now understand that this is a key document to help you plan for your retirement into the future. And as your statement contains multiple estimate projections, depending upon your age, as you can see on screen here. So this is a good starting point for you to plan for your retirement and to start thinking about what your target retirement date is going to be. As your statement shows, all members have the options to increase and maximize their tax-free cash lump sum. As per the middle column there, that shows the kind of tax-free cash lump sum that you can convert. But what this means is that you can swap some of the pension that you've built up for lump sum payment. And that's done on the following basis that's shown on the slide there. So if you can see in red there, for every £1 of pension that you've built up, you can convert that into £12 of immediate tax-free cash lump sum payment in return. There is a maximum lump sum that is set by the tax authorities, the HMRC, and that can only be up to 25% of the capital value of the accrued rights. But most importantly, as you'll see in the later slides, by having an AVC product in place, this means you don't have to swap all of your valuable pension that you built up with your hard work in order to maximize your tax-free cash. Overall, though, if after looking at your current position and projections on your annual pension statement, you feel this doesn't give you the pension amount you desire for the future, then, or you may actually have to work longer than you had anticipated, then as this presentation will show, there are ways for you to top up and pay extra for your specific pension needs and objectives. A very useful resource in the pension sector is the Retirement Living Standards website, which is shown on the slide here. They compile an annual survey, they being the Pensions and Lifetime Saving Association, the PLSA for short. And what this survey does, it pitches 3 levels of retirement models: a minimum, moderate and comfortable model. And it's all based on a basket of goods and services, from food and drink to holidays. And you can plan against this for your lifestyle objectives. This tool is designed to help you engage with the type of spending you think you will need in your retirement, and will help you to plan for it. From this, you can judge whether the retirement income you have is going to match your desired future lifestyle. And as you can see from the survey levels of income, you'll need this corresponds to whether, what you'll need on an individual or a basis of a couple. As mentioned in my introduction, there are 2 vehicles available to you in terms of the products, in which you can pay more to increase your overall benefits at retirement. And we'll look at these in more depth in the upcoming slides. But in summary, the first option is ABCs, which stands for additional pension contributions, and it's a way of increasing your actual overall main scheme benefits and increasing the annual pension you build up in the LGPS specifically. The second option is AVCs. It stands for additional voluntary contributions. The second option, this is separate to your LGPS pension benefit, and is set up with a third-party provider in the case of AVCs, and is separate to the fund, and it's a separate fund that you build up, which you can access at retirement. So when added to your LGPS pension, will increase your overall benefits at retirement. So in terms of the first option available to you to increase your benefits at retirement and to provide the level of income in line with your plans is an APC. As explained earlier, this method will purchase additional annual pension in the LGPS pension scheme that is linked to your employment record. To set up an APC contract to buy additional pension, you must be in the main section of the scheme. All members are contractually entered into the main section of the scheme, and it's only following an election from yourself as a member that you would move into the separate 50/50 section. If you are in the 50/50 section, then you are not able to set up an APC contract to be fully aware of this restriction. An APC allows you to increase the annual pension by a maximum of £8,344 at the current time. This is the figure as of April 2024, and it will be adjusted in line with inflation in the future each April. Once an APC contract is set up, the additional contributions are deducted in the same way as your normal pension contributions are deducted from your pay each month, and this means you'll receive further tax relief, provided you're a taxpayer, of course, as both your main scheme and additional contributions are deducted prior to tax being calculated. You can decide whether you wish to pay the cost of an APC contract as regular instalments or to be paid as a one-off lump sum. Please note, if you do elect to decide for the lump sum option, you would need to claim the tax back through the tax self-assessment process. For regular instalments, payments must be at least £10 per month. APC contracts are set up to run for whole years, so 1, 2, 3 years or up to 30 years as an example, but the maximum number of years is up to your normal pension age. The shortest period you can pay over is 12 months. And if you're less than a year from your normal pension age, you can only pay by a lump sum, just to be aware. So for any members who hold more than one pension record as a result of holding more than one employment with your employer, you need to make a separate election for each role or specify which of the roles you're paying APCs upon. The additional pension you are purchasing is only in respect of your member benefits and not for survivors' benefits, just to be clear in regard to this. You can only take out an APC contract if you are an active member of the scheme. So this means you're actively contributing to the scheme and you haven't opted out of the scheme and hold a deferred or frozen benefit. An APC contract you have set up will cease when you reach your normal retirement age or if you leave that employment. In addition, the APC contract will cease if you join the 50/50 section of the scheme, as I mentioned. So for any members who do have an APC set up and are then considering moving into the 50/50 section of the scheme, you'll need to have consideration of this before you make your election. If you are considering proceeding with an APC, then I'll now cover the steps you need to take to set up an APC contract. First of all, you'll need to access the APC calculator. This will allow you to work out how much pension you want to purchase and what the cost will be for purchasing this extra pension. This will allow you to look at whether you wish to pay by regular instalments or as a one-off lump sum, as an example. It's important to remember here that the contributions are based on your age and the period over which you're purchasing that pension. The calculator tool can be accessed via the link that's shown on screen there, and it's provided by the local government association at their LGPS member website, which also holds a wealth of information about the LGPS, so it's well worth looking over. This method of payment is also the same way in which you would buy back any periods of lost pension when there was a period of unpaid leave. The additional pension purchased via an APC will be reduced if the pension is taken before your normal retirement age, to bear this in mind, with the exception of ill health retirement, just to be aware of this. So once you've clicked on the link, you'll be presented with the tools and calculators section of the LGPS member website. Under the Buying Extra Pension Calculator section, please click the Calculate Extra Pension Contributions button to do this. You'll now be asked to complete the online form, and you'll have to provide some details. So each of the boxes is marked with an asterisk to denote a required field which needs to be completed, and the question marks can be clicked to offer more guidance. So in terms of the first question on gender, obviously click down the drop down box and click the appropriate option. In terms of date of birth, click on the calendar icon at the end of the field and use the drop down arrows to select the appropriate year and month. In regards to section of the scheme, you'll only be allowed to set up an APC if you're in the main section of the scheme. So select the appropriate option here. But if you do select the 50/50, it will not allow you to proceed. Percentage is what your employer has agreed to pay. If your employer has agreed to contribute to an APC contract, the agreed upon percentage can be entered here. And then finally, select the radio button on here on how you want to pay. So you can select either by regular payment or lump sum. And with all of these options fields completed, then obviously you can now click continue in green there at the bottom. You now have the option to choose how much you want to pay. So this is the total amount you want to pay when you click calculate. This will tell you the total extra pension that you're going to buy. So in this example, we're going to choose to buy £1,000 of extra pension. We're going to state we want to pay over 12 months in terms of what we want to do. And now if we click calculate, we can now wait for the results to be shown. So it's as simple as that. As mentioned earlier, we advise that the cost is based on your age and the period over which you're paying it over. So we've done a comparison on the next slide for someone who's younger in profile, so someone age 23, and someone who's a bit older in profile, age 53, to show the differences in the kind of results and costs that you would get. So here's the calculation results. For a male aged 23, we look at the cost of purchasing £1,000 of extra pension. So this will increase the annual pension at retirement by £1,000. The regular cost before tax relief is £527.60 per month. The results will also show the relevant pension age, which in the case of this member is 68. Which is again based on the person's age. So the quote is unique for each member in that respect. So in the case of this result, because they're a much younger profile of member, you can see the kind of value of the sums that you would need to pay in order to take up an APC contract. So in contrast, let's look at someone older in comparison. So for a male age 53, we're looking at, again, at the cost of purchasing £1,000 of extra pension via an APC. So again, this will increase the annual pension at retirement by £1,000. The regular cost before tax relief is £1,036 per month in contrast. Again, the results show the normal pension age, which is 67 for this much older person. So by these two comparisons, you can see the big differences in the costs here. So generally speaking, the expense of an APC rises with age and the later you start an APC contract. So that brings us to the end of the APC option. So what I'd like to do now is just cover some of the key points you'll need to consider in deciding whether this is an option for you and your circumstances. So to highlight, an APC contract purchases additional pension benefits within the LGBS, to be clear. So this increases the annual pension you're entitled to, as I've shown by the calculator example earlier. With an APC, you know what you're going to get at normal retirement age, so there's no uncertainty or reliance on other factors. The pension is guaranteed and is an index-linked income, so this means it's inflation-proofed and it's payable for life. So in terms of the inflexibilities, so you are effectively purchasing a set amount and the cost is a set payment if you're choosing to pay by regular payments or by paying by a lump sum. It's more expensive the later you start, as I've said earlier. The value of the benefits is reduced if you retire before your normal pension age, unless you retire obviously on the grounds of ill health. And in the event of your death, prior to claiming your APC, there are no death benefits due from the APC. This only buys pensions specifically for you, just to be aware. In this section of the presentation, I'll now introduce and explore the second option available to increase your pension benefits, known as AVCs or additional voluntary contributions. As advised at the start of this presentation, this option is separate and in addition to your main scheme benefits, and it's arranged through the third-party AVC providers that your pension fund has elected to use. In summary, this slide shows the respective providers that the fund's partner with, who are household names in the financial services industry. The contributions are deducted from your pay in the same way as your normal main scheme contributions and are subject to tax relief, as you'll see on the next slide. Those contributions are then paid into your AVC fund provider, who will then manage the investment of those funds. And they're based on the options that you will have selected from your available investment options. Note the tax savings that you receive are higher if you are a higher rate taxpayer. AVCs have a greater flexibility when it comes to the contribution amounts and can be varied as your circumstances change, and they can be stopped or restarted as you might choose. Sorry. So in this next slide, if we use the example slide shown on the slide of a basic 20% rate taxpayer, what this means is if you decide you're going to contribute £100 as an example, then the actual cost to you would be £80 if you consider the tax savings. So you're saving £20 on the level of tax you pay. So in terms of tax relief at the basic rate, the cost to you in your take-home net pay is going to be £80. However, you're getting an AVC contribution of £100 because it's deducted from your gross pay. The tax saving doesn't actually increase the amount you're contributing into the AVC fund. If you decide to invest £100, then you are still going to invest £100. As I mentioned again, the higher the tax rate pay you are, the benefits will be greater in terms of tax relief for yourself. There are several factors that can influence the performance of your AVC fund, as your AVC pot is effectively an invested amount. This means it can go down as well as up, and depending upon the investment returns and performance of the fund. So when setting up your AVC plan, you can choose how your AVC is invested according to your attitude of risk. Hence, low risk would potentially mean low reward, medium risk for medium reward, and for high risk, the potential for even higher rewards. At the point of your retirement, your AVC funds can be used to buy additional pension in the LGPS, or used to buy an annuity from the AVC provider, or to purchase on the open market. An annuity is a way for you to turn your AVC fund into a secure income that will be paid to you in addition to your main scheme benefits and your pension. Additionally, and subject to HMRC limits, your AVC fund can also be paid as a tax-free cash lump sum. This means you don't have to swap your valuable pension you've built up with your hard work to maximize your tax-free cash, as I've shown earlier in the annual pension statement slide. The value of your AVC fund at retirement will depend on how much you've contributed, as well as how well the funds have performed over the years on the market, and then all this up to the point of your retirement. If you die before claiming your AVC fund, this will be paid in line with your death grant nomination for your main scheme benefits. To access further information on AVCs, you can visit our website at www.wypf.org.uk, where you can access the information under the Paying Extra section. From here, you can access guidance by way of the AVC fact sheet, or by clicking the AVC options at retirement for active members or deferred members, which will take you to the respective pages. If you also scroll down to the bottom of the page, there are links for the specific funds, and when you click on the contact details, the AVC provider details are provided for you to look up. So on this next slide, we're going to show an example of clicking through to Prudential as a provider and doing a quote. So in this example, we're assuming the member is earning £20,000 per year, is a non-Scottish taxpayer. The pension pot starts at 0 and the member contributes for a period of 15 years. The contributions that would be made would be based on a 3% contribution rate, which costs £40 per month, as you can see just at the top of the screen there. So let's see what this would mean for an estimated pension fund value. So the first part is the total cost to you. This is the amount based on the 3% of the salary that you've contributed and the number of years the member has contributed. So this will be the amount that will come out of your pay each month for the total of the 15 years, and this will amount to £7,200, as you can just see just there at the top there of that box. The next part is the total actual amount that goes into the pension pot on your contributions, and this actually amounts to £9,000. So this demonstrates the amount of tax relief that you receive on your total contributions of £9,000. Because of the tax relief that is applied to £7,200 you've contributed, so this has only cost you £7,200 in actuality. What this means is you have received £1,800 of tax savings, as it shows on the box there. Additionally, the potential growth of £3,487 is the growth in your investments less the charges. Hence, the total fund value after 15 years is £12,487. This would be in addition to the LGPS main scheme benefits you have accrued. An alternative option potentially available to you is a shared cost AVC. However, to note, this option is only available if your employer has decided to offer this option to members. So please contact your employer to see if this is an option that's available for yourselves. Shared cost AVCs enable you to build an additional pot of money alongside your pension with contributions exempt from both income tax and national insurance contributions, with the potential to obviously again take it all as tax-free cash lump sum when you retire. The AVC contributions are then paid again to the AVC provider and taken from the employee's net pay via the use of salary sacrifice, on which the employer also makes a saving by paying less national insurance. As it's a shared cost AVC, the scheme must be operated on a shared cost basis, so you will be required to pay £1 per month as your contribution to the shared cost AVC arrangement. Your employer pays the rest of the value you have decided to pay into the shared cost AVC, but your salary will be reduced by the amount of the APC contribution that your employer makes on your behalf. That's why it's called a salary sacrifice scheme. So if you were to pay £100 per month, £99 will be the salary sacrifice amount and £1 will be your personal contribution. In summary, the benefit is both to you and the employer of paying less national insurance contributions in this approach and income tax. So here, so here we have an example of a shared cost AVC. If we use the example of the slide of a 20% basic rate taxpayer, this means if you decide your contribution is going to be £100, the actual cost to you would be just over £72, as you can see there. Hence, if you consider savings you're making nearly savings of nearly £28 on the level of tax and national insurance you pay. The tax and NI savings doesn't increase the amount you contribute into the AVC fund per se. If you decide to invest £100, you're still going to invest £100. But it does mean the tax and NI relief on the £100 is deducted, is accounted for, and will reduce your level of tax being deducted from you. So this brings us to the end of the AVC option. So I would like to now just cover again some of the key points you need to consider in deciding whether this option might be suitable to you and your circumstances. Firstly, there is greater flexibility when it comes to the contributions, and it can be tailored to your own personal circumstances as they change. You are in control of the cost by deciding how much you wish to contribute, and this could be by specifying an amount you wish to pay or as a percentage of your pay. The benefits are not reduced for early retirement, and there are a number of options open to you with your AVC, including you can increase your tax-free cash at retirement, use it to increase your income at retirement, or a combination of both subject to the HMRC limits. In the event of your death, the AVC fund is paid as a lump sum to those you have nominated as your death grant nominees. The main point you need to bear in mind in considering AVCs is that it's not guaranteed like your main scheme benefit, so you won't know exactly what you're going to get at retirement. This will depend as mentioned, on factors such as the fund's investment performance, market fluctuations, the actual amount you're able to contribute to the AVC, and the level of this you've opted for. Overall, the actual value of your fund will be influenced by all these factors to the point of retirement and when you access your AVC. So moving on in terms of support we can provide for yourselves, if you have any questions, queries, or any scheme-specific scenarios you're struggling with, or you still require some assistance, then please do get in touch with ourselves at our customer service team contact centre, who will assist you. The details are displayed on the slide here. You can contact us via email on the contact centre team mailbox, or call the contact centre helpline for assistance. We also have a lot of information on our website at www.wypf.org, which is our scheme-specific channel. If you are considering retiring soon, then you might be interested in joining one of our pre-retirement planning sessions online run by our partners Affinity Connect. They will help you to keep your retirement plans on track and to help you to start planning for your retirement. These sessions run throughout the year, and you can book to attend one of these sessions by visiting the pre-retirement page on our website on the link that's shown on screen. So please check out our website for the dates and book on to one of these very useful courses. So before I bring this session to a close, I'd just like to carry out some administration duties and read through the disclaimer on the screen here. This presentation has been issued to you by West Yorkshire Pension Fund. The guidance has been prepared on the fund's current understanding of the scheme regulations, and therefore should not be treated as a complete and authoritative statement of the law. Users may wish or will need to take their own legal advice on the interpretation of any particular regulations. No responsibility whatsoever will be assumed by the fund for any liability, financial or otherwise, incurred by stakeholders relying on the statement. The fund does not accept any responsibility or reliance on the contained or referred to in this guidance. So following on from this session, we'll be sending out a survey. If you could take some time to complete and return that would be very much appreciated. The session today has been recorded, and the slides will be available on the website shortly. So again, thank you for your time today. There may be a number of questions in the chat box, and so I think we may have some time to answer those now.
Okay, that's great. Thanks, Ahmed. So I am just going to take the opportunity just to address some of these questions that we've got through throughout the session. So firstly, all the slides are already on the website. They're all there and the link is in the chat. After this week, what we'll have to do is we'll have to process the recordings and we'll get those published. So they will be available early next week, and that will be for all of the sessions. If you weren't booked on, or if you didn't attend the sessions, you will still have the opportunity, of course, to catch up on any of the sessions. Something else that I will say is that we do run online sessions generally throughout the year, not just for Pensions Awareness Week. So if you are looking to learn a bit more about the scheme, we do very, very regularly run online sessions, and we call them Engage with Your LGPS Pension. So do look out for those, because you don't have to wait till Pensions Awareness Week to join us for one of these sessions. We are very keen on educating members on the pension. So now I'll just move to some of the specific questions about the two different options. So firstly, if we consider the APC option, you can't contribute to an APC if you're in the 50/50 scheme. So there's a couple of questions on that. The 50/50 section of the scheme is essentially you pay half the contributions and you build up half the pension. You can, however, have an AVC if you're in the 50/50 section of the scheme. So a couple of questions around kind of the cost of an APC and what you get back. So with an APC, what you're buying is you're buying additional income. So it's not an additional lump sum that you're buying. So if you sign up to buy an additional £1,000 worth of pension, you've got to bear in mind that that £1,000 is going to be paid to you every single year in your retirement. So for you to determine whether or not it's a good choice for you or a good investment, essentially you need to know how long you're going to live, because that's going to determine how much money you're going to get back from your APC. The APCs are guaranteed, so they will be payable for life, no matter how long that may be. You know, you could live till you're 100, 110, and that will continue to be paid. So it's that you need to take into consideration when you're making your decision. Some people are attracted to the APCs because it's a guaranteed income. So they've got the security to know that they've got that additional income in their retirement, no matter what happens. So obviously the prices are dependent on your age. The older you are when you set them up, the more expensive they're going to appear. And that is simply because obviously the older you are when you set them up, you're closer to the time that you're actually going to be drawing the pension in relation to that APC. So hopefully that answers the questions that came through on the APC. So I'll just move on to some of the bits that came up about the APC. So first question that we've got here is, do you have to choose between APC and AVC? And the answer is no, you can do both. That's absolutely no problem. And also, if you did have an AVC and when you came to retire, it was actually better for you to essentially buy an APC with that money instead of an annuity, you do have that option as well. So let's have a look at some of these questions. So with an AVC, it's not a fixed rate. You can pay as much as you want into your AVC. You can pay all of your salary into an AVC if you wanted to. If it's a shared cost AVC, there are limits to what you can contribute. So with a shared cost AVC, just to be clear, that's where the cost is shared between you and your employer. But the incentive to a shared cost AVC is that you also gain NI relief. Okay, so you're saving the tax and you're also saving the NI contributions. Now, not all employers offer the shared cost AVC, so that is completely dependent on whether your employer does facilitate that option for you. But anyone who's a member of the LGPS can contribute to an AVC. So with an AVC, what you're doing, as Ahmed mentioned, is you're building up a separate pot of money that's invested with the fund's AVC provider. You are saving on your tax if you are a taxpayer. So what happens with your AVC, that builds up over time. Of course, you're saving 20% or 40% in tax if you are a taxpayer, of course, basic rate or higher rate. And then when you come to retire, you have a number of options with that AVC fund. So one of the options that's available to you, if that AVC fund doesn't exceed 25% of the capital value of your pension, you can have that AVC back as tax-free cash, meaning that you don't have to trade your pension from the LGPS in order to get that tax-free cash lump sum. You can have the cash from your AVC fund. Alternatively, you can use your AVC to buy an annuity with your AVC provider or on the open market, or you can put it back into the LGPS and essentially buy a APC with it at retirement. And that's a choice that you can make at retirement. So you do have a bit more flexibility when it comes to your AVC at retirement, because you've got a number of choices that you can make. In terms of your employer paying into these additional contracts, that is something that they can do, but it is at their discretion, and it's part of their discretionary policy. We don't tend to see it very often that an employer will also pay into an additional contributions contract, but of course it is an option. Your employer does already pay a considerable amount into your pension on your behalf, and you can find out what that is by looking at the pension fund reports on our website, depending on which pension fund you're in. The AVCs aren't going to be shown on your annual pension statement, so you'll when you come to retire, you'll get your retirement pack, and all your AVCs will be included in that. Let's have a look. What else we've not addressed? So what is the difference between a standard and a salary sacrifice shared cost AVC? That's a really good question. So your standard AVC is essentially you get tax relief on that. Every member of the LGPS can set up a standard AVC. The salary sacrifice option is where you are sacrificing some of your salary, essentially. So your contractual pay is reduced by the amount that you wish to contribute into your AVC. So the incentive for a salary sacrifice AVC is that you save on national insurance contributions, and so does your employer. So paying into a salary sacrifice AVC, you're going to see you know, a bigger saving individually, because you're not paying the tax on those contributions, you're not paying the NI on those contributions. But as I mentioned, the salary sacrifice option, the shared cost option, is only available if your employer is facilitating that option for you. Is there a survey in the UK whether APCs or AVCs is more popular? There is no survey, but the AVC does tend to be more popular. But it is completely down to your personal circumstances. Regarding the risk that you take with your AVC, again, that is a choice that you make. You may wish to simply invest your AVC contributions in what we call a deposit fund, where there's no risk, or you can invest it in other funds that the AVC provider offer, where obviously you can attract returns, but also you can attract losses as well. But that's a conversation that you have with your AVC provider to determine what's best fit for your needs. Another question. I have an existing AVC. Can I move into a shared AVC? The answer is yes, but only if your employer facilitates the shared cost AVCs. Generally, if your employer does, what will happen when they move over to the shared cost AVCs, they'll move it over, because don't forget there's an incentive for them because they save the national insurance. So it's worth asking the question, because your employer may not have thought about it. They may not, you know, realise that it's an option. So it's worth asking the question, because all employers can offer it, but of course it's just something that they have to facilitate. Okay, is there a maximum amount as a taxpayer you can contribute? So you can pay as much of your salary as you want into an AVC. However, you're also kind of restricted under the annual allowance limits. That doesn't stop you paying all of your salary in, but if you do exceed your annual allowance, it just means that there are certain tax implications potentially for you. So that's a kind of a two-part answer. No, there isn't a limit in terms of how much you can pay, but if you're exceeding your annual allowance, there may be additional tax implications that you have to consider. Excuse me. Okay, that's a very good question. So if you retire early, do you get the full additional pension, or does this come into play at retirement age? So if you are buying an APC, you're buying an additional £1,000 worth of pension, £2,000 worth of pension, whatever you sign up to do, it's only worth that to you at your state pension age. So if you do retire early, that's absolutely no problem. But what's going to happen is that pension, just like the rest of your pension, is going to be actuarially reduced, again, to take into account for the fact that we are paying it to you over a longer period of time. So again, that is something that we would encourage you to think about when you are making that decision. Okay, how do I calculate the capital value of accrued rights? Okay, so roughly that is, and this is only a very rough guide. Is your annual pension multiplied by 20, and then you add in any standard lump sum that you've got and add in any ABC fund that you've got, and then it's 25% of that. To get an accurate figure for your 25%, you can work with your ABC provider to get a more defined figure, but roughly that is, broadly speaking, the calculation. Yep, that is correct. Lincolnshire County Council are starting to offer the shared cost ABCs from October. If an employer offers share cost ABCs and I already pay ABCs, will I be moved across automatically? Generally, that's what happens, but you may want to double check that with your employer, because that's not necessarily what they have to do. It's just generally what does happen. Does having a salary sacrifice ABC with an NI relief affect my state pension? No, it doesn't, and that's a really key point. When you're paying into a salary sacrifice ABC, what the ABC provider will make sure is that you're not paying in too much to mean that you're not hitting those NI contributions that you do need to be hitting for to get your qualifying years for your state pension. So no, it doesn't affect your state pension. I think that might be all the questions. Okay. So unless anyone has any further questions for us this afternoon, you are free to leave the meeting. Hopefully that's been useful for you. Oh, we've got another more. We've got a few more. Okay, that question from Elaine, that is something that you would have to have a conversation with your financial advisor. Obviously, what we've done today is gone through the facts around each option. We aren't in a position to advise what's best for you, because what's best for one person may not necessarily be best for the other. And there's lots of unknown kind of factors, which makes it impossible for us to advise what is the best option for you. So if you're in any doubt whatsoever as to which option is better for you, then we would encourage you to seek financial advice. Do employers have to offer APC? Yeah, it's not an employer decision. It's an option within the fund. So every all scheme members, all members of the main scheme, apologies, can set up an APC. How can you find out the percentage that the employer pays APC? The employer doesn't necessarily pay for the APC. It's something that generally is paid for in full by members. So that's not something that you would be able to find out. They may make a contribution towards it, but like I say, it doesn't happen very often. Question there on the ABC provider. So each pension fund has a partner, an AVC provider. So it could be that they have one or two to pick from. It could be that it is just Prudential. So each AVC, depending on which pension fund you're in, West Yorkshire, Lincolnshire, Barnet, Hounslow, the pension fund has their own respective AVC provider, and it has to be one of those providers. The recording, as I mentioned, will be on that link that I've shared, but that won't be available until next week. And question there from Elaine. What you need to find out is you need to ask for a pension savings statement from us, and then you can share that with your financial advisor, and then they should be able to work out roughly how much additional contributions you can make without breaching your annual allowance. So if you want to contact if you email us, email our contact centre, and that will be directed into our service centre. We'll have to do some calculations for you. Okay, right. So thank you very much, everyone, for joining us. Yes, there is a lot to take in, so please do catch up on the slides and obviously the recording. If you do have any follow-up questions, we can certainly answer questions on a factual basis, but we certainly can't give you any advice. So yeah, thank you very much, and you are free to leave the meeting.